A warm welcome to the Share Detective video channel. Important information and disclaimer. This video is intended solely for general information. If you have any doubts about the suitability of an investment for your circumstances, you should always seek expert advice. Today, we're going to look at how you can search for growth stocks using the low peg. One of the most useful valuation tools used by many growth share investors is the PEG, otherwise known as the price-earnings growth ratio. The PEG is used as a filter to identify stocks that look reasonably priced in relation to their forecast earnings growth rates, and that therefore may be ripe for a status change and a re-rating. Simply put, the PEG identifies stocks with price-earnings ratios that are less than their forecast earnings growth rates. To achieve this, we need to do some screening and filtering. To find stocks with low pegs, you screen stocks setting a filter whereby only shares that meet certain criteria are selected using a stock screening tool such as Sharescope. A potential list of growth stocks typically might be generated using criteria such as PEG of less than or equal to 0.75 and an above average forecast earnings growth rate over 20%. Let me explain this to you. What is a PEG? Well, to qualify for a PEG of 0.75, for example, a stock might have a multiple of 6 and forecast earnings percentage growth rate of 8. So you simply calculate it by dividing 6 by 8 to give you 0.75. A key aspect of all this is that investor perceptions are likely to change over time. Assuming one's analysis is correct and a company grows its earnings consistently, say 20% a year, then all other things being equal, it is at least likely to maintain its multiple or rating. Its share price, by definition, is therefore likely to rise by a corresponding 20%, assuming, of course, there is a correspondingly positive outlook statement. However, if the company continues to meet market expectations or even exceed them, investors' expectations of the growth prospects for a consistent growth stock are likely to increase, and over time a higher multiple is likely to be awarded by the market. And this is where we get to the re-rating of stocks through the double whammy effect. For example, any resultant re-rating by the market from, say, 8 times earnings to 12 times earnings would produce an additional 50% increase in the share price. This has been referred to in the past as the double whammy effect. It is quite possible, therefore, for a share price to rise more as a consequence of changing investor perceptions than as a result of an actual rise in earnings, and of course, vice versa. I hope that you have found this brief explanation of the PEG useful. Indeed, Share Detective uses the low peg technique quite often when selecting his stocks and shares. Goodbye for now.